This podcast includes content created using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast. Before we continue, we'd like to mention that the Luxembourg Fundcast is created and produced by Bertrand Mariot, a practicing regulatory lawyer admitted to the Luxembourg and Paris bars. The mission of this podcast is to bring clear, free, and reliable information sourced from official references that are carefully curated and continually updated and refined through high-standard, evolving prompt engineering on Luxembourg's financial regulation and investment funds to professionals and anyone interested in the Luxembourg Financial Center. Okay, let's unpack this. Today, we're embarking on a deep dive into a topic that's really fundamentally reshaped the corporate landscape. The Corporate Sustainability Reporting Directive, or CSRD, as you probably know it. And look, this isn't just another regulatory update, is it?
No, not at all. It's much more profound.
It marks a really strategic shift. It takes sustainability from, those high-level, often voluntary ideas.
Nice to haves, almost.
Exactly. Into something legally mandated.
Yeah.
With granular reporting, rigorous auditing. It's a real moment of truth for governance, I think.
It really is. It forces companies to look squarely at their impact and, their future resilience.
And here in Luxembourg, this isn't coming completely out of the blue, right?
No, the groundwork has been laid to some extent.
Yeah, the Luxi's Principles of Corporate Governance, especially that Principle 9 on sustainability, that's been setting expectations domestically for a while.
It certainly has, pushing for more robust governance there.
So now CSRD arrives and basically codifies all that. It makes it hard, enforceable law, weaving sustainability right into corporate accountability.
That's a good way to put it. Woven into the fabric.
Now, one crucial thing for everyone listening today. All the analysis, everything we discuss, it's current as of the 21st of August, 2025.
Yes, that's key. Things are moving fast.
Absolutely. This field is so dynamic, so we want to give you the very latest understanding based on developments up to that date. So in this deep dive, our mission, really, is to get beyond just the theory of CSRD.
Right, into the nitty-gritty.
Exactly.
Yeah.
We want to dissect the practical challenges, the stuff companies are actually facing right here in Luxembourg during implementation. And our focus, it's squarely on the strategic role of the governance professional. That's you, listening. How do you navigate this demanding new terrain? We'll look at the legislative side, how it's evolving, dive into those operational hurdles that early adopters have already flagged.
And those are proving quite insightful.
Very. And we'll talk about those critical, often really complex conversations that need to happen within the Audit and Risk Committee.
Right.
So to guide us, I want to flag 3 sort of must-know insights, key takeaways for any senior governance professional. These are the threads we'll keep pulling on today. They really capture the strategic imperative here. Here's where it gets really interesting, I think. First insight. Those recent EU-level postponements. The Stop the Clock Directive.
Ah, yes, the famous delay.
It's created what some are calling a strategic whipsaw effect.
That's a good term for it.
Yeah, it's not just a simple 2-year break. It's a critical decision point for boards. Do they pause, reallocate, or maybe seize a first-mover advantage?
It's a real test of strategic thinking, absolutely.
Second point, and honestly, we can't overstate this, the double materiality assessment, the DMA.
The absolute cornerstone.
It is. And as the CSSF's latest findings make crystal clear, it's the primary area where companies are, stumbling.
The practical execution is proving tough.
Totally. Mastering it, executing it well, and crucially, documenting it. That's not just about ticking a box. It's about validating your strategy, making sure you're audit ready.
Non-negotiable, really.
And third, that mandatory assurance requirement in CSRD. It fundamentally transforms sustainability oversight.
Oh, completely. A game changer.
It moves it irrevocably from maybe a communications function, something peripheral,
soft,
right, into a core non-negotiable responsibility of the Audit and Risk Committee itself.
Elevating its mandate significantly.
Hugely. Demanding a whole new level of diligence, new expertise from those committee members.
It really does.
So we'll circle back to these 3 at the end, but definitely keep them in mind as we go through the details. Okay, so with those key insights framing things, let's dig into the core changes. What does this CSRD framework actually mean in practice here in Luxembourg? To get the practical side, we first need to understand the basic architecture, right?
Makes sense. The foundations first.
So the Corporate Sustainability Reporting Directive, CSRD, It's the successor to the NFRD, the Non-Financial Reporting Directive.
The previous regime.
Exactly. And NFRD, look, it was a decent first step, but it had well-known shortcomings.
Definitely. Comparability was a major issue.
Big time. It led to inconsistent data, quality varied wildly, you just couldn't reliably compare companies.
Yeah, it lacked teeth in some ways.
So CSRD was designed specifically to fix that, to bring in a common standardized reporting framework across the whole EU.
Harmonization is the goal.
And the engine driving that standardization, that's the European Sustainability Reporting Standards, the ESRS.
Developed by EFRAG.
Right, the European Financial Reporting Advisory Group. And it's really important to get this. ESRS aren't just high-level guidelines.
No, they're the detailed rule book. Mandatory.
Absolutely. They cover the full spectrum, environmental, social governance, detailing what companies have to report. It forces that comprehensive, consistent approach.
That move from broad principles to really specific, granular rules is the key difference, isn't it?
It really is. It
Yeah.
sets CSRD apart.
And a key insight here is just the sheer scope of information that's now seen as having financial implications, even if we used to call it non-financial.
Right. The lines are blurring.
Completely. The ESRS, thanks to EFRAG's, very detailed work, they're incredibly granular. They don't just say what to report, but precisely how to measure it, how to present it.
That level of detail was totally missing under NFRD.
Exactly. And the ambition behind this whole CSRD design is genuine comparability. That apples-to-apples comparison everyone talks about.
Which investors desperately need.
Investors, regulators, stakeholders, everyone. Imagine being able to confidently compare, say, two companies' carbon emissions or their diversity numbers, knowing the data is solid, verifiable.
That's a huge leap.
It's monumental. Moving from, sometimes qualitative, voluntary stuff to quantitative, auditable disclosures.
It acknowledges that these sustainability issues, they have real material impacts on a company's finances. It's long-term health.
Precisely. Embedding them firmly within statutory reporting, not just off in a separate CSR report somewhere.
Okay, that brings us neatly to one of the most, dynamic and strategically tricky bits, the timeline.
Ah, the timeline saga, yes.
It's been quite a roller coaster, hasn't it? The original schedule was, let's just say aggressive.
Very ambitious.
It had the first wave, the NFRD companies, reporting on 2024 results in 2025.
Which felt incredibly soon for many.
And then a second, much bigger wave reporting on 2025 and 2026. That really put pressure on, didn't it?
Absolutely. It drove a huge amount of activity, investment in readiness projects across Europe, certainly here in Luxembourg too, through 2023, 2024.
But then early 2025, things shifted dramatically.
The landscape changed quite suddenly.
Yeah, the European Commission, responding to all those concerns about the burden,
The administrative load, yeah.
they released their omnibus simplification package in February. And that led directly to Directive 2020-5794.
The Stop the Clock Directive.
Exactly. Quickly nicknamed that, published officially April 16th, 2025.
And it essentially hit the pause button.
It fundamentally reset the clock, pushed
Yeah.
reporting back by 2 full years.
So the new schedule.
Okay, new timeline. First wave, that's large undertakings, issuers with over 500 employees, the ones already under NFRD, they now report in 2028 for the financial year starting January 1st, 2027 or after.
So a 2-year shift for them.
Right. And the second wave, other large undertakings, they report for the first time in 2029 for the financial year starting January 1st, 2028 or after.
Same 2-year delay.
Correct. And this big shift brings us right back to that whipsaw effect I mentioned earlier.
Because companies had already geared up.
Precisely. Those tight initial deadlines, forced action budgets allocated, teams assembled, consultants hired, and the sudden delay. It's not just, more time.
No, it creates a real strategic puzzle.
Exactly. It's a complex dilemma. And for you, the governance professional, your advice here is absolutely critical, helping the board weigh the risks, the benefits of basically 3 different paths forward now.
It's a crucial advisory role. A real test of foresight, as you said.
Definitely.
And you're right, that whipsaw term captures it well. It's more than just tweaking a project plan. It has a real psychological impact, a practical one, on organizations that had already sunk significant cost and effort.
You have to manage expectations internally, too.
Absolutely. Reevaluating commitments. So boards face this choice, with real trade-offs on each side. This is where governance professionals really show their value.
So let's break down those 3 paths.
Okay, so the first path is essentially pause.
Hit the brakes.
Exactly. Stop the readiness project, reallocate that budget, maybe even disband the team, The immediate attraction, short-term cost saving, obvious appeal there.
But the risk?
Huge risk of losing momentum. All that institutional knowledge gain, the processes started, the relationships built across departments, gone.
Dissipates.
Yeah, which means a frantic scramble later, maybe 2026, 2027, under even more pressure as the new deadlines loom. Likely lower quality, probably higher long-term costs because you're inefficient.
The classic penny-wise, pound-foolish.
Precisely. Then path 2, maintain pace, become a voluntary early adopter.
Forge ahead anyway.
Right. Stick to the original timeline despite the delay. Now, obviously, the costs keep coming. The budget outlay continues now.
But the upside?
Potentially immense strategic advantages.
Mm-hmm.
You position yourself as a market leader. You satisfy those sophisticated investors who want this data now ahead of your peers. That's powerful.
A real differentiator.
Huge. Plus, you embed these complex processes without that intense deadline pressure. You can build more robustly, more efficiently. Use foresight for competitive advantage.
Makes sense. And the third option?
Path 3, which many see as the most prudent, recalibrate.
Not stopping, but adjusting.
Exactly. Use the extra 2 years intelligently, not frantically rushing, but doing a more thorough, less pressured implementation. Focusing on the really hard stuff.
Like data quality?
Data quality, absolutely. Establishing robust internal controls for non-financial info that's often way underestimated. And achieving deeper integration into core strategy.
Turning the delay into an opportunity.
Precisely. Fortify your foundations rather than just taking a break. Build something much more resilient, valuable, auditable.
So this really raises that crucial question, doesn't it? How do boards weigh that short-term saving against the long-term strategic gain, especially in this dynamic environment?
And that's where the governance professional's advice is paramount. It needs deep insight, not just the legal text, but the company's strategy, its market, its capabilities, helping the board move from being reactive to being proactively strategic.
Guiding that crucial choice. Absolutely. Yeah. Okay, so we've covered the why and the when. Let's look at the where. What's the legal status here in Luxembourg right now, August 2025?
Right, the national picture.
So CSRD is in the final stages of being transposed into Luxembourg law. It's happening via Draft Bill 8370.
Okay, 8370.
It was submitted to the Chambre des députés, our parliament, back on March 29th, 2024.
So it's been in the system for a while.
Yes, and it's gone through that standard, rigorous legislative process Luxembourg is known for. Reviews, opinions from key bodies.
Like the Conseil d'État.
Exactly. And professional chambers like the IRE, the Institut des Réviseurs d'Entreprise, our auditor's body.
Getting that expert input.
Crucially, though, the bill was amended on May 6th, 2025.
To reflect the delay.
Precisely. To formally align the national law with those new delayed timelines from the Stop the Clock directive.
So Luxembourg is adapting pragmatically.
It is. Now, the original transposition deadline for the main CSRD was July 6, 2024. But for the Stop the Clock directive itself, member states have until December 31st, 2025 to get that into national law.
Okay, so there's still a bit of time on that specific alignment piece.
Right, which means while the direction is clear, the legal framework here is still technically a fluid and active legislative file.
Which requires ongoing monitoring.
Absolutely. Continuous monitoring is essential for companies and advisors here.
And connecting that to the bigger picture, it really highlights Luxembourg's approach, doesn't it? Commitment to EU alignment, yes, but also pragmatically adjusting to those wider European concerns about the implementation burden.
A balancing act.
Exactly. And the fact it's still an active legislative file means governance professionals can't just sit back. You need to track Draft Bill 8370, watch for any tweaks.
Because even small changes could matter practically.
Absolutely. It shows how dynamic regulation is. Anticipating change is almost as vital as reacting to it. It fits Luxembourg's reputation, sophisticated, responsive financial center.
Okay, framework understood. Let's pivot now to the really practical side of implementation, where theory meets operational reality.
Where the rubber meets the road.
Exactly. And where your role as a governance professional becomes absolutely central. Let's get into the hands-on challenges. First up, mastering the double materiality assessment, the DMA.
The big one.
It really is. Cornerstone, yes, but also, as we'll see, the single biggest practical challenge. Within the ESRS, the DMA is the mandatory process that defines the whole scope of your sustainability report.
Get it wrong, and the whole report is potentially flawed.
Precisely. Without a robust, defensible DMA, you can't confidently know what to report on, or, crucially, what's going to be assured by the auditors.
It requires that dual perspective.
Yes. Looking at materiality from two angles. First, there's impact materiality.
The inside-out view.
Right. Assessing the company's actual and potential impacts, positive and negative, on people and the environment. And crucially, not just your own operations.
The whole value chain.
The entire value chain. Suppliers, end users, everything. Are your processes causing water scarcity somewhere? Human rights issues deep in the supply chain? Classic impact questions.
Okay. And the second angle?
Second is financial materiality, the outside-in view.
How sustainability affects the company's bottom line.
Essentially, yes. How do sustainability matters create financial risks or opportunities for the company? Think climate risks, extreme weather hitting assets, supply chains.
Or transition risks, like carbon taxes.
Exactly. Or opportunities, new green products, attracting new investors. Those are financial materiality factors. The critical point, often missed. A topic is material and must be reported if it meets the criteria for either impact or financial materiality. Or both, of course.
It's an or test, not an and test. That's vital.
Absolutely vital. Now, the practical steps for a DMA, they're pretty rigorous. Involve identifying a long list of potential impacts, risks, opportunities, IROs.
Stakeholder engagement is key too, isn't it?
Hugely important. Engaging with employees, customers, investors, regulators, communities. Understanding their views on these IROs. Then assessing severity, likelihood. And finally, applying clear, predefined thresholds to figure out what's actually material.
Sifting through the noise, as you said earlier.
Exactly. Finding what truly matters for reporting.
And this is precisely where we see theory hitting that, unforgiving reality, and where those early adopter lessons are gold dust.
The CSSF report comes in here.
Right on cue. The CSSF's brand new report, just out this month, August 2025, CSRD, first year of reporting by issuers. It analyses Luxembourg issuers who voluntarily adopted ESRS for their 2024 reports.
So real-world experience.
Exactly, and its findings. A critical roadmap of pitfalls to avoid. Essential reading.
What did they find?
Well, they found that while nearly 60% of the issuers in their sample are voluntarily adopting the full ESRS, the quality and rigor of their DMAs varies dramatically.
So tick in the box, but maybe not substantively.
That's the risk. This isn't a minor point. It's the core challenge. The report flags several critical issues these early reporters are facing.
Such as?
Many struggle badly with scaling their judgments and providing truly entity-specific disclosures.
Meaning they're too generic.
Exactly. Instead of precise, tailored info relevant to their unique business, they use generic statements that could apply to anyone, which defeats the whole purpose of CSRD providing decision-useful, specific information.
You give an example.
Sure. Instead of just saying, we manage energy, a specific disclosure might be our data center in Bissen cut its PUE by 10% via AI-driven cooling. Specific, measurable, relevant.
Okay, got it. What else?
Another big one. Poor linkage between a material topic and the specific IROs arising from it.
So they say climate change is material but don't connect it properly.
Precisely. They don't clearly articulate the specific risks like flood risks to their assets, carbon tax impact on their supply chain, or the specific opportunities like their new green product lines. Makes the report vague, hard to audit.
And the third key issue.
Critically, the CSSF found many reports lack clarity on whether impacts are assessed on a gross or net basis.
Before or after mitigation.
Exactly. Is the reported impact the raw number, or the number after you've taken steps to reduce it? That distinction is vital for understanding the real footprint and how effective mitigation is. Auditors need to know.
Affects credibility massively.
Totally. So these CSSF findings, invaluable. They show the DMA cannot be superficial. Your role as governance professional is key. Guide the board, management, to establish a robust, defensible, auditable methodology.
Facilitate workshops. Document rationale.
Meticulously document everything. Define thresholds clearly. Apply them consistently. It's about grounding the narrative in verifiable reality, not just aspirations. Steering the board away from vagueness towards evidence that stands up to scrutiny.
Keeping them focused and rigorous.
Absolutely. That's the core governance role there.
Okay. Beyond the DMA, another huge practical change is the reporting paradigm itself. How and where this info gets disclosed.
The mechanics of reporting.
Right. CSRD mandates the sustainability statement must be a distinct, dedicated section within the company's management report.
No more separate, glossy PDF hidden somewhere.
Exactly. No standalone report published whenever, it's integrated, which means the board formally approves this sustainability info with the same gravity, same responsibility as the financials.
Bringing it into the core financial orbit, as you said, linking it to accountability.
Totally. And then there are the technical requirements. The whole management report, sustainability included, must be in XHTML format.
The single electronic reporting format?
Yes. And the sustainability info within it needs digital tagging using XBRL, aligned with ESEF, the European Single Electronic Format.
Like a digital barcode for every data point.
Good analogy. Lets computers instantly read, understand, compare data across companies. Turns reports into insights for investors, regulators.
Making it machine readable, feeding the European single access point. Transparency, accessibility.
So for governance, this means complex new coordination with finance and IT. Getting the tech infrastructure, the processes right for these digital mandates.
It's not just content anymore, it's format and access.
Precisely.
And that's such a critical point. Embedding it in the management report, same board approval, it elevates the status massively. Signals that sustainability performance is just as integral as financial performance.
More than just formatting. A strategic statement.
Absolutely. And those digital requirements, XHTML, XBRL, tagging, they demand serious cross-departmental work, often a rethink of data architecture.
Finance and IT need to collaborate closely.
Intensely. Finance teams, often handling ESEF tagging for financials, now need to extend that to sustainability data, which comes from all over the place. IT is crucial for system setup, data collection, aggregation, tagging.
It's not a simple add-on.
Far from it. Complex data mapping to ESRS taxonomies, ensuring consistency across HR, operations, environmental systems, implementing data validation. The governance professional is pivotal here, facilitating this.
Ensuring everyone understands resources are allocated, infrastructure built.
Yes, establishing data flows, internal controls for non-financial info with the same rigor as financial data, turning a technical hurdle into an exercise in organizational data governance.
Which brings us to maybe one of the toughest, often underestimated roles for the governance pro, internal negotiator, the orchestrator.
Ah, the diplomacy part.
Yes, it's so important to stress. CSRD is not just for legal or compliance. The need for data from the entire value chain suppliers to end users makes it truly enterprise-wide.
Touches every corner.
Every single corner. Often needing input from departments totally new to corporate reporting.
So the governance professional has to be that central coordinator.
Exactly, the orchestrator, skilled at negotiating, aligning diverse teams. Finance, HR, operations, procurement, sales, legal.
All holding key pieces of the puzzle.
Absolutely. Energy data, diversity metrics, supply chain due diligence, product impacts, their active, informed, enthusiastic participation is non-negotiable. Like conducting that orchestra, everyone needs to play in harmony.
And this is where those soft skills are just critical, arguably as vital as the technical legal knowledge.
You see in job descriptions now.
You do. Collaborative work style, build relationships in diverse multilingual settings. That's not jargon, it's necessity. Imagine coordinating data from Global Ops Asia, the US, managing those internal stakeholders, bridging cultural divides, non-negotiable internal diplomacy.
And negotiating budget,
right.
Resources.
Absolutely. Convincing busy department heads, already stretched, of the strategic importance their team's role. Establishing clear data ownership, internal controls for this non-financial data, like for financials, who collects what, how is it validated, how does it flow?
Defining those processes.
Exactly, which leads to that key point. How do you translate dense ESRS requirements into practical, understandable data requests for non-legal colleagues?
Can't just hand them the rule book.
No, you need to distill it. Actionable steps, clear templates, ongoing support. Explaining Scope 3 emissions to procurement might mean showing how it links to supplier footprints, why that data matters now.
Sophisticated project management and communication.
And persuasion, organizational skills.
Yeah.
It's right at the heart of modern corporate governance, moving from compliance to strategic enablement.
Okay, now let's hit arguably the most transformative piece.
Yeah.
The assurance mandate.
Where the stakes really rise for the Audit and Risk Committee.
Yes. CSRD legally requires the company's statutory auditor, the Réviseur d'entreprise agréé in Luxembourg, to provide an independent limited assurance opinion on the sustainability reporting.
Limited assurance initially, but still external validation.
Exactly. And the single requirement, it changes the game completely, elevates sustainability reporting from, maybe voluntary communications led
to a regulated, audited discipline on par with financial reporting.
Precisely. And here's the direct link to Luxie's X principles. Principle 8 clearly gives the audit committee remit over financial reporting, internal control, risk management.
And now, assurance on sustainability data brings that squarely into their court.
Irrevocably. It's under the direct formal purview of the Audit and Risk Committee. No longer a soft topic delegated elsewhere.
They are the undisputed epicenter now for this. Same responsibility as for financials.
So the critical task for you, the governance professional, meticulously prepare this committee for its significantly expanded role.
Concrete actions needed.
Essential actions to ensure they're equipped for this new scrutiny.
Absolutely. The shift is profound and it's permanent. The governance pros task here is multifaceted, critical.
What are those actions?
First, educating the committee. Proactively briefing them not just on CSRD broadly, but ESRS specifics, DMA intricacies, the nuances of limited assurance.
Bridging that knowledge gap.
Exactly. They're financially astute, but maybe not sustainability reporting experts. Workshops, briefings, expert resources are needed so they can ask the right questions, exercise oversight effectively.
Second,
Updating the committee's charter, reviewing, amending their formal terms of reference to explicitly include oversight of sustainability reporting and external assurance, formalizes responsibility, removes ambiguity, gives them the mandate.
avoids gray areas when auditors arrive.
Precisely. Third, and maybe most strategically, facilitating rigorous dialogue, structuring agendas for deep, critical examination,
Challenging management.
rigorously questioning management on DMA methodology, choices made, and providing a separate forum to grill the external auditor on their plan, findings, control weaknesses, building that robust challenge function.
Equipping the chair with the right questions.
Absolutely critical. Like, what were the most contentious DMA topics? How was the final decision rationalized? Walk us through the debate, the data.
Or about supplier data validation.
Yes. How did we validate Tier 1 supplier data? What's the auditor's view on that process? And crucially, what were the biggest control deficiencies found? What's the remediation plan, timelines, ownership?
Tough questions.
Necessary questions. What's compelling is the sheer shift in diligence, expertise needed from committee members, profound, permanent change. Sustainability moves from periphery to central board responsibility, same scrutiny as financials, embedded in corporate value.
Okay, let's talk practicalities. The elephant in the room, costs.
Ah, yes, the budget conversation.
Implementing CSRD is significant. It costs money. Governance pros need to articulate this, justify it, build the business case.
Several key cost centers.
First, new and unavoidable, external assurance fees. Significant addition to the audit budget. Auditor provides an opinion now.
Then often, consultancy fees, expertise needed for DMA, data strategy, report drafting, specialized work.
Definitely. Next, technology investment. Software for data collection, consolidation management, that XBRL tagging, can be substantial CapEx, needing integration with ERP, HR systems.
And the biggest, often hidden costs.
Internal resources, staff time. Across multiple departments, dozens, maybe hundreds of people involved. Not a one-off, it's ongoing human capital commitment collection, validation, process design, controls, continuous investment.
And pricing this internally, budgeting for it, it's sophisticated negotiation, value articulation.
Justifying it beyond just avoiding fines.
Exactly. Justify it by the strategic benefits of high-quality, assured reporting. This isn't just expense connected to the bigger picture. It's strategic investment in future corporate value.
How so?
Proactive investment leads to tangible returns. Enhanced access to capital sophisticated investors demand credible ESG data, assured CSRD reporting. Could be the deciding factor for a major pension fund choosing your fund over a competitor. Lower cost of capital.
Better risk management, too.
Significantly, DMA forces systematic identification of new risks, opportunities. Mitigate disruptions, seize opportunities. Strengthens stakeholder relations, builds trust, credibility with customers, regulators, employees. Enhances brand, attracts talent crucial in Luxembourg. And competitive advantage. Tangible advantage. In a market demanding authenticity, strategy backed by audited data stands out decisively. Hard for peers to replicate without the real commitment. These are the long-term returns.
Okay, and timelines. That 2-year delay isn't complacency time, right?
Absolutely not. Breathing room, yes. Invitation for complacency, definitely no. If you're targeting your first report in 2029 for the 2028 financial year, the project must start now, late 2025.
Leverage the time intelligently.
Yes. A high-level plan. Scoping, methodology design for the rest of 2025. Data collection pilots, gap analyses in 2026. What data do we have? What's missing? What's the quality?
Then full implementation.
Full-scale implementation, tech deployment, internal control testing throughout 2027. Goal, fully prepared for that first mandatory reporting year, 2028. Phased approach is key.
So what happens if companies procrastinate? Assume the delay means they start later.
Big risk. That CSSF report clearly shows thorough prep is needed, highlighted the struggles of early adopters, a rush job, risks, quality, accuracy, audit readiness.
Auditors want robust processes.
Clear data trails, effective controls. A last-minute scramble won't meet that standard. Could mean qualified opinions, non-compliance penalties. Proactive action is needed now, not later.
So wrapping this up a bit, what does it all mean beyond just compliance? This is where companies can really build that unique selling proposition, isn't it?
Exactly. Why quality compliance is a strategic choice.
High-quality, assured sustainability reporting. It's not just nice. It's a core part of corporate value now, a determinant of long-term success.
That's the paradigm shift, moving beyond compliance burden to strategic differentiator.
We touched on some benefits, but let's recap why it's strategic: access to capital.
Crucial. Sophisticated investors integrate credible ESG data. Assured, granular data is a prerequisite for growing capital pools, often on better terms. Green bonds, ESG loans, easier access.
Improved risk management.
Definitely. Rigorous DMA forces identification, assessment of new strategic risks and opportunities. Climate, social, governance risks. Proactive mitigation boosts resilience.
Strengthens stakeholder relations.
Hugely important. Builds trust, credibility with customers, employees, regulators, communities. Enhances brand, retains talent, fosters community ties. Invaluable asset today.
And tangible competitive advantage.
Yes. In a market demanding authenticity, clear strategy backed by audited data stands out. Differentiates you from peers treating it as just compliance. Translates to market share, loyalty, stronger competitive position. So that critical observation again, shifting from burden to differentiator, redefining how value is created, communicated, demonstrating how sustainability is integral to the business model, future success. A complete picture of corporate health.
Finally, though, CSRD, as massive as it is, isn't the end of the story, is it?
Not by a long shot. The landscape keeps evolving.
Governance pros need to keep watching the horizon, anticipate the next wave.
Proactive stance is key.
And there are things on that horizon already. Sector-specific ESRS.
Postponed, yes, but not canceled. When they arrive, they'll add another layer detailed industry-specific requirements. More granular disclosures for energy, agriculture, etc.
And the other big one, CS3D.
The Corporate Sustainability Due Diligence Directive operates alongside CSRD. Timeline adjusted, yes, but its requirements go way beyond reporting.
It's about action, not just disclosure.
Exactly. Mandates active identification, prevention, mitigation of adverse human rights, environmental impacts in own operations and value chains. Deeper operational engagement, risk management needed.
A significant step further.
Connecting it back, CSRD isn't an island. It's foundational for this bigger EU regulatory puzzle for sustainable economy. The robust data, controls, governance built for CSRD, essential for CSRD compliance.
One enables the other.
You can only do that proactive due diligence credibly if you have the CSRD foundations. Doing CS3D without CSRD readiness, a massive uphill battle.
So the crucial question becomes, how do companies future-proof their strategies for this continuous evolution?
It's not about a static fix. It's building flexible, scalable systems, embedding a culture of continuous learning, adaptation on ESG across the organization.
Not a one-time project.
An ongoing commitment. Building a dynamic framework that absorbs new requirements as they emerge rather than reacting from scratch each time. That ensures long-term resilience, value creation.
Okay, as we wrap up this deep dive, let's quickly revisit those 3 key takeaways.
Good idea.
First, that Stop the Clock directive. It's a strategic crossroads, not a vacation. How companies use this extra time will separate leaders from laggards. Using it wisely builds competitive edge.
Crucial decision point.
Second, double materiality assessment, the practical heart. And as CSSF shows, the biggest challenge. Rigorous, auditable DMA is non-negotiable for real compliance, meaningful reporting.
Get the DMA right.
Third, mandatory assurance. Places the Audit and Risk Committee front and center in sustainability governance. A fundamental permanent shift. Demands new diligence, expertise, just like for financials.
Elevates the committee's role irrevocably.
Ultimately, CSRD isn't just about reporting, it's a catalyst. Transforming governance, forcing integration of financial and non-financial info, redefining how value is created, measured, communicated.
An opportunity for real leadership.
Indeed. Thank you for joining us on the Luxembourg Fundcast. This podcast is a collaborative and free resource that improves continually, so your comments or requests for new topics are highly welcome, especially on YouTube. We want to be a helpful strength for everyone working in the Luxembourg Financial Center at all levels. We are often asked how you can help us. Well, a great way to help is by subscribing to our shows on all major podcast platforms, including Spotify, as well as on Apple Podcasts, where a 5-star rating would really help us. You can also like our videos and subscribe to our Rigor Media YouTube channel. All relevant links will be available in the show notes. For our French-speaking listeners, you can also find our sister podcast in French. It was the Luxembourg Fundcast for you today. This podcast includes content created using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance.